Charles Nenner is a former Goldman Sachs technical analyst. These days, he's executive director of the Charles Nenner Research Center, and he joins us now. Charles, nice to see you.
Well,
You've got a few charts. I'm going to kind of work our way through those. Then I want to get your take on what's happening with maybe the wider markets, gold, what's happening with euro, dollar. But let's kick off with treasuries and what's happening in the bond markets. You've got a German yield here in Europe that's yielding 145, 150 over the last couple of days.
amazing.
Yeah, amazing. Treasuries, again, kind of similar story, but haven't been keeping pace even with the bunds. Put a cyclical overlay on this for me.
You know, I do my cyclical work, which seems that prices don't move at random.
Yep.
So we're not influenced by what the Fed or the governments do. And I brought you an example. This is a 30-year cycle of the bonds. What you see is the blue is the yield, and the red one is our cycle, and it goes back to 1780. And the interesting thing is I bring it up because usually people are usually on the wrong side of the markets when the major turning points. And what you see is that we're right at a turning point in the low of yield. It's a very regular cycle. That means it's from top to top. It has the exact amount of years and amount of months. It's amazing. So this actually proves that whatever a government or a Fed or whatever does or whatever happens in the economy doesn't change anything. It's first a cycle, and we react to the cycle. And when there's a cycle low, we're going to do something that will bring up the yields. So what we see here is that now we're up for 30 years of higher yields, and we're about to turn around. So I don't want people to carry it away with the low bond yields because it's almost over.
And that's a very long duration chart.
Correct.
You say almost over in the next few years, in the next few months, in the next few weeks?
No, our major cycle is turning around in September.
Right.
I think then the bull market in the bonds is over.
So you've got a little bit left to run if you're just,
yes,
for tactical asset allocations,
yes,
a little bit left to run. And do you think the trend will continue for lower yields during that period, or do you think
until
we're kind of
September?
forming a base?
But don't think that I mean that the economy is going to pick up. I don't think the economy is going to pick up. I just think that it's going to be a trouble to get funded, and people just want a more risk, they have risk aversion, so they want a higher yield for their bonds. So I think the world is in trouble, and the yields are going up not because of inflation, not because of strong economy, because of fear.
Right.
So they're not, you know, if a government wants to sell a bond, now you have to give more premium because people don't trust you.
Yeah, that risk is that theoretically, according to regulation, shouldn't be in a sovereign, is definitely going to be in a sovereign. Chemicals, the building blocks of a modern economy.
Right. So I made an index of the big chemical stocks in Europe because they always predict where the economy is going, and my cycle really topped and is down for a while, which means is that we're going to have a recession, maybe even depression, or very negative on the economic growth in Europe. What you see over here is the same situation. You see that the blue one is the index of the major chemical companies, and our cycle topped and it's now down. So I expect the economy to follow and to be weak. Right.
And but interestingly enough, you're probably expecting the economy to pick back up again, sort of what, 2014 into
right,
2013, 2014.
Right, right.
Talk to me a little bit about how this affects stocks. You brought us the AEX, but is that just something I can extrapolate across the rest of the stock market space?
Yes, it was specially made because some pension fund in Holland asked us to build a cycle on the stocks. This one was stopping already in March, so it's not totally updated, but you see that the cycle is down, and already the AEX lost 10% since that cycle top. So there's a low coming up, you see somewhere there, but the final low is not in yet. So you have to be very careful with stocks for the moment.
Right. Be careful with stocks. Get ready to sell fixed income.
Right.
And you're expecting a fairly major recession.
Yes.
What's the flip side to all of those trades? I've seen you talk about gold.
No, gold we sold gold at 1900, and we're still out of gold. It's a period that you have to learn from history. This is a period where you don't try to make money. You're happy if you don't lose money.
So where's the I hate to use the phrase safe haven, but where do I seek protection?
There's almost no safe haven.
Right.
My idea
cash?
to big cash. But my idea to big investors is, although I think real estate can go much lower, I still don't trust the bank. So I say still buy real estate. At least you have something. And in 10, 15 years, it will come back to the same price, because I also think we're going to have a major banking crisis. So it's a very, very tricky environment for investors. First of all, what asset class to have, and then in which bank to keep your money.
What about looking at sort of the inflation story? The picture I'm getting from you is that there is no inflation in the system, despite the money that's being pumped in.
Right. It's coming, but not yet.
I was about to say, when does it come? Because with all the liquidity that's being thrown at the system, at some point, that has got to work its way back out again.
I think the crash that people talk about for the last 20 years, that the dollar's coming down, people don't trust the dollar anymore. I was not in that camp. I'm now slowly getting in that camp. I think the dollar's going to get in trouble in 2014. And if we really get a dollar coming down, that will lead to inflationary situations in the rest of the world. So I think it will start in 2 or 3 years, not yet.
In the meantime, what happens to the euro?
It's interesting. My price target euro is 128.50. As long as 28.50 is not taking out on a closing basis, let's say in Europe.
Pretty close to that right now.
But we're holding every day there. So I wrote a couple of months ago 128.50 is a level. If you break through, we go to much lower levels.
Much lower means?
Could go to 110, but I don't expect it. I even think that if Greece or maybe another weaker brother like Portugal would go out of Europe, people would like the euro, because actually with the stronger countries, the euro is the currency you want to be in.
Because it becomes the Deutschmark effectively again.
It becomes, right. Totally correct. And it's not that they like the euro, it's just at this stage is which currency is worse. So the euro, if you take out some of the weak countries, is going to be a reasonable, stable currency.
With the demand outlook that you're painting for me, commodities look fairly soft.
They look very soft.
Softer than they are now. Give us a Brent target, give us kind of where we go with the major copper, oil, etc.
We're short the copper, we're short the crude. And on my long-term cycles, again, we work a cycle of 200 years. I think most of the bull market of commodities is over for a couple of years.
So the super cycle's done?
Yeah.
Implications for... it's interesting putting that back with the chemical stocks. One of the big things for chemical stocks is input costs, but I guess if the demand side of the equation is bad, then it doesn't kind of matter what the supply side looks like.
Exactly.
What does it mean for China?
China is an interesting case. I just want to mention that in 1900, China was the second biggest economy in the world. China has had big periods. They just don't have the Western way of looking at it. And it's not a given that if China becomes a big economic power, that it will stay a big economic power. That has to do with Taoism and the way of Chinese life. They try to introduce capitalism now, but it's not really in the Chinese mind. So it's not a given that China in a couple of years will also be the big superpower like we expect it to be now. China is now easing restrictions, but looking at the stocks in China, it's also not the place where I want to buy stocks at the moment.
Charles, the policy response to the recession you're predicting is what?
There's going to be a policy response. I mostly am in the United States, and I get phone calls from people of parliament in the Netherlands who have to vote on what to do now. And I must tell you, there's almost nobody who understands the difficulties of the situation. That's number one. Number two is, you mentioned the word super cycle before. There's also a super cycle in capitalism. It is about 250 years old. We kept it going by pouring in money and having credit for people, but we're at the end of the super cycle, and we have to realize at a certain moment there's not much you can do. Kondrachev, the clever guy in the 20s in Russia, he already predicted that capitalism would go under. Stalin and people didn't like him. They put him in jail because he says, but they're going to take 100 years, because they wanted to prove immediately that communism was better. But I think in the end he's correct. You cannot keep the credit going.
The Marx-style crisis of capitalism is on its way?
I think so.
And we can't keep that going with liquidity?
No, I don't think so.
They're going to try?
Yeah, but it's just postponing the crisis, because every politician says, not in my name, I want to forget, they should forget about me when the crisis is there. And every Fed president says, let's try to continue, so I will go into history as a good Fed president. The longer you postpone it, actually it started when we went off the gold standard already. We didn't want to have a recession, we didn't have a depression, so we push it forward until we have a major bang, and there's nothing you can do about it.
Ben Bernanke's known as Helicopter Ben. He's going to try and carry on with it, but we're going to have to leave it with that thought because time beats us. Charles, lovely to see you. Thanks for stopping by. Charles Nenner here in the studio.